here comes. It's my honor to introduce our keynote speaker, Dr. Michael Samis, principal at SCM Decisions. Michael is a professional mining engineer and a leading integrated valuation and risk modeling practitioner in the natural resource industries with more than 35 years of mining experience. He has extensive experience using dynamic cash flow models to access mining projects from the exploration stage through the late stage capital investments, as well as project financing, contingent taxes, and corporate portfolios. Mike has taught professional courses on real options and dynamic cash flow modeling for more than 20 years at universities, natural resource companies, and professional organizations worldwide. He was previously a senior manager and associate partner at Ernst & Young's Toronto office for 11 years, where he valued financial derivatives in addition to his valuation work in the mining industry. Before this, he was technical director of mineral economics for a large engineering firm. He currently assists clients to align their capital allocation decisions with their business strategy through SCM Decisions. Today, he'll be discussing the complexities of mining investment decisions, including declining deposit grades, commodity price uncertainty, investment flexibility, and how dynamic cash flow models can capture features static models over time often miss. Michael, thank you for joining us. The floor is yours.
Hello, let me just get set up here. I was going to get my share my screen and then also get my presentation lined up here. So let me.
Super.
Yeah, let me see. There we are. So everyone can see the presentation. I'm just going to get the.
Looks excellent.
Let me just. There we are. Just going to do a couple more things here. And there we are. Okay, so I think
nice.
Jameson, everything seems to be up and running right now.
Looks good.
Okay, great. Okay. So, well, hello, everyone. I'm really happy to be here to have a chat about dynamic cash flow modeling. It's something that I've been involved with for a long time, very interested in. I've always found it very intellectually challenging and professionally, also very fulfilling. And I first came across this back in, I guess I'd say back in the early 1990s when I was down in South Africa, and dealing with the perennial question of why. When do you shut down a South African gold mine when the gold price was around $300 an ounce? And that got me into real options, and I've been here ever since. So what we're going to do today is talk a little bit about how we use dynamic cash flow modeling in the mining industry, and or you can use it to better understand your mining investments. Just before we get into it, just a disclaimer here. I'm going to be using some case studies I put together from public information on a number of projects that are out there. And the key thing here is just to realize this is all publicly available information. It's my own work. I haven't really worked with any of the companies that are involved with these projects. And so this is my own take on putting together a case study. And the key thing about these case studies is that I'm trying to demonstrate with them how we go about using dynamic cash flow modeling to improve the insights that we have about a mining investment. Now, for mining, for those of you who may not be familiar with mining, it's really about the business about getting, metal out of the ground and out into the marketplace, which you can sell. And that top graphic there, that's giving you giving you an illustration of what an ore body might look like. The gray there is the surface, and then the colored area here, that's the 3D representation of the ore body. And the challenge for a mining company is, how do we get that ore that's in the ground out and then turn it into cash. And for that, we need to understand the ore body, spatial extent, how much of the ore or the metal bearing rock is in the ground, metal concentration. We have to come up with a design to actually mine the ore, and then a mill to actually separate the metal from the rock. And all this takes a lot of effort to design and a lot of technical know-how. We also have to have the execution ability to do this. The company needs to be, have the resources to do this, the manpower, the technical knowledge, and you also have to have, the permits and the social license to operate. And then lastly, you also need a financial incentive. This has to be something that is, economically attractive to do. And so the way we actually go about deciding this is once we've done our design, we got all our permits in place, we build a cash flow model to model, will this project look like something that's worthwhile doing? And the problem with our cash flow model, if it's, if it doesn't work very well, we can actually lead us to making a poor investment decision or suggesting an inappropriate structured financing structure. Now, what makes this hard for us is not only that is all the technical know-how and the, trying to figure out what the ore body looks like and things, is all this is done in when we're dealing with uncertainty. And we tend to have three sources of uncertainty, or three broad categories. That's the way I like to look at it. We have market uncertainties. So what are the commodity prices? What are the prices of the metal that we're going to sell for inputs, energy prices, these sorts of things. We have technical uncertainty, geological, what's in the ground, what sort of design are we going to use, to get the metal out of the ground and separated from the rock. And then we also have to worry about execution risk, where, do we have the corporate ability to actually, build a mine and then operate it? Do we have the permitting? Do we have, social license to operate and access to finance? All these sorts of things are risky and uncertain, and they can impact whether our project is a success or not. And right now, the way we go about this is we use a static cash flow model where we have forecasts for metal prices and production parameters and things, and all that risk that we think is out there, we tend to summarize it in an aggregate discount rate that we use to calculate a net present value. Now, as I mentioned, this static cash flow model, this is the predominant tool that's being used in the mining industry, and that's going to give us some information when we build this model to look at our project to decide if it's something that we'd like to to build and design and operate. And we'll get some summary statistics from it, things like unit costs and ratios, payable metal that will actually generate some cash from. We'll get an indication of project quality, where we have net present values and internal rates of return. But what we won't get, because we're just looking at a single forecast model, is we're not going to get information about risk and cash flow variability and these sorts of things. So we won't get information about nonlinear cash flows and real options, things like operating flexibility, nonlinear financing arrangements that can transfer risk in funny ways, and we won't have information about our risk exposure. And so what's exciting about dynamic cash flow modeling is it gives us not only just what the static cash flow model gives, but it also gives us additional information about how the project will perform in the future across a much wider range of future possibilities. So that's what's exciting about a dynamic cash flow model. Now, all the tools that I use to build a dynamic cash flow model and to do my analysis, I sort of call it integrated valuation and risk modeling. It's really a dynamic cash flow modeling framework. It's combining things like finance theory, decision analytics, and risk management concepts. The reason why I call it integrated valuation and risk modeling is, 12 years ago or 15 years ago, when I was out talking to clients, I talk about real options and people would say, oh yeah, I know all about that. And and then I would say, well, yeah, but I'm also doing, with my analysis, talking about, risk exposure. And that's, people would start to get interested in that. And so I really needed a way of saying, yeah, we're not just calculating a value or a real options value, but I'm also taking a look at risk and trying to talk about our, exposure to uncertainty. And this IVRM pyramid I have here, we have some basic building blocks. You have models of uncertainty, numerical methods, finance theory, risk measures, statistical analysis. And one of the most important things in our building blocks is our communication tools. And the reason why these communication tools are really, really important is I can build a very fancy model and I can use all this great math and stuff. But if I don't have the ability to communicate the analysis, then all that effort goes to waste. So it's really important to think about how you're going to talk about these ideas that, these insights you generate with these models. And with those foundational blocks, we can get into project analysis, looking at flexible project design, the ability to measure value and risk, contingent finance, contingent taxation, and risk assessment. And then we also take that up once we look at all our different projects in the company into the corporate portfolio level, where we can look at enterprise risk management and qualitative risk assessment, contingent risk, corporate strategy, and balance sheet risk, and those sorts of things. So there's a lot we can do with this. Now, some of the building blocks that I have here, probably one of the more important ones is price uncertainty. And within the mining industry, we have a number of different models that we use for modeling metal price uncertainty. We have something called a non-reverting stochastic process for gold and silver. And I know it sounds very complicated, but it's quite interesting is when you use model risk and you pair it with Excel, you can build these models for gold and silver in about 5 rows of Excel. And it's fairly straight, it's really straightforward to do that. Now, the thing about gold and silver, that top graphic there, that's just the black line is showing you the historic gold prices from the start of from January 1st, 2000 up to about 2015. The black line is historic prices. The colored lines, those are the forward prices. These are, at a particular point in time, a specific date, you can actually agree to buy gold in the future. And those colored lines are the price at which you would buy an ounce of gold, 1 year or 2 years or 3 years in the future. And what's interesting about that structure is you can see that there's this parallel shift in the forward curve, which is in a sense a parallel shift in our forecast for gold price. And so what we need to be able to do when we build a model for a gold price uncertainty is actually build that sort of structure into our uncertainty model. And the graphic at the bottom there is showing you what that type of uncertainty model would look like. Once again, the black line there represents historic gold prices. And then when you get to the middle of January 2025, we then simulate that gray line that's jumping around. That's one simulated price path. And then you'll see the colored lines. The solid ones are forecasts. And what you're seeing is those move in parallel as your spot price moves up and down. In this case, a simulated spot price. The dashed lines represent confidence boundaries. And what those are showing you is sort of the range of possible gold prices in the future. So if you look out 10 years from the middle of 2025, there's an 80% chance the gold price will be between $2,000 an ounce and I look there roughly and 6,000. So this is a way of modeling gold price and silver price uncertainty. Now you might be going, well, that looks really complicated. Do I have to do it? Can I use something like a triangular distribution? And no, you can't, because what's interesting is if you go into financial reporting, this is the type of model that all the CFOs and the mining companies are using when they model gold price uncertainty for gold price derivatives and financial contracts that are tied to gold prices. We have a different type of price for model for base metals and energy. We have something that's called reverting models. And these are where spot price bounces around your a long-term equilibrium price. And so, yes, you get price uncertainty, things bounce up and down, but there's always economic forces pulling spot prices back to a long-term equilibrium level. And the bottom graph there is showing you what this might look like. This is copper price since the mid 1980s. The black line's your historic price, and then when you get to the middle of 2025, we have a long-term forecast price of $4. But when we simulate it, we allow prices to bounce around that $4 mark. And what's different here than compared to gold is you see the confidence boundaries tend to stabilize after a couple of years. And what's happening there are supply and demand forces are tending to pull the spot price back towards your equilibrium price, and that sort of caps the overall level of uncertainty in copper prices. So when you look out 10 years, 80% of the time, your model is saying copper prices will be between $6 and about $2.75 or $3. So those are the two types of price models that we have. We also have to worry about operating costs, operating leverage. And to give you an example here, imagine you have the low cost and the high cost copper mine. If your copper price at the start, the current time is $4, and a year later you think it could be between $3 and $5 or $5, and with an expectation of a copper price of $4. What's interesting about this setup here is both the low cost mine and the high cost mine both have expected cash flows of $10. What separates them though is their unit costs. The high cost mine, you're producing at $3 a pound, and the low cost mine at $2 a pound. The thing about the low cost mine though, that leads you to have a cash flow uncertainty of plus or minus 50%, whereas the high cost mine would have a cash flow uncertainty of plus or minus 100%. And the issue with that is, the high cost mine is obviously much more risky, but I've seen a lot of times with mining companies, the tendency is to use we got different projects we're considering, let's just use the same discount rate to value the cash flows, even though you might have very different levels of cash flow uncertainty in both those projects. We also have to worry about nonlinear cash flows. You might have heard of a paper that was put out by a Harvard professor that talks about the flaw of averages. This can be quite important when you're dealing with financing and taxation. The graphic on the left there is just showing you two different payoff profiles over a range of gold prices for a royalty. The red one is what we call a sliding scale royalty. And what happens here is as the gold price changes, the royalty rate changes. So at low gold prices, you might not pay anything to the royalty holder, but then as the gold price goes up, you may pay 1%, 2%, 3%, 4 or 5 or 6. The blue line shows you the payoff structure of a royalty where it's you're paying a constant 3% royalty rate. So this is a very common government royalty approach. And the thing about this is, in the case of here of a gold price of $800 an ounce, both royalties would pay out $12 million. But when you run a simulation and you look at how the different royalty terms distribute cash flows, what you realize is a sliding scale royalty actually has a much higher expected cash flow over the life of the project than the ad valorem or a constant royalty. And you can see on the graphic on the right-hand side, the histograms showing you the distributions of the cash flow distributions of each royalty. And in this case, the sliding scale royalty it generates about $30 million more than the ad valorem. So that can lead to cash flow estimation errors in your static models. We also have to think about flexibility. I use decision trees quite often. And the thing I know about when I look at or from when I was working for an engineering company, quite often when you approach a new project and you're trying to figure out a design for it, you might try 3 or 4 different approaches to doing your design work, or 3 or 4 different designs, and you'll use a static model to try and assess which one is best or creates the most value. So really what happens is, that top graphic is showing you what your decision structure looks like. You've got 3 different designs in this particular instance, and one is where you're front loading capital, another one is staging capital, and there's another version of staging capital as well. The key thing here, though, is the issue for the project managers is you're going to be making a decision right up front about which one is best for your project. And what's interesting about this, if you look at the decision tree below this, the bottom part of the slide, this is a decision tree for a dynamic cash flow model. And what you're seeing here is that the same 3 choices actually just filled out a bit more about some of the decisions you have to make. And for example, here you have a choice between 2 different design approaches. And, the bottom one, you actually have a few other, or in each case, you have a few other follow-on design choices of whether to go after low-grade pits or go underground and these sorts of things. So what you're seeing with decision trees and flexibility is you have future investment choices that may change your view of different designs. So the choice between front-loading capital in a project versus staging capital, where you're investing in the project on a more of a sequential basis. Now, the thing about all this, we're dealing with uncertainty, we're dealing with nonlinear cash flows, we're dealing with flexibility. We're going to have to start thinking about how we're going to, what sort of dynamic or what sort of numerical techniques we're going to use. And the numerical technique you use really is going to depend on what you're trying to get out of your model. I mean, if you're not really worried about risk characteristics, and your project is such that these nonlinear cash flows don't really impact your analysis, so a high margin project, then quite likely you can just get away with using a single scenario static cash flow model in your analysis. So that's one option, and that's something that people use very frequently across the mining industry. But if you are interested in risk characteristics and you think that these nonlinear cash flows, kink cash flows, are going to be an issue, then you have to start thinking a bit harder about how you're going to do this. And if you're doing analysis where you don't need, for example, an intermediate project value. For example, you're building a gold project, and hey, what's the value of my project in year 5 if gold price is 4,500? That, in year 5, that's an intermediate project value. If I need that information, then I'm going to have to go to something like dynamic programming, which is fairly specialized. But if I don't need that, and that's quite often the case, then you can just carry on with using a simulation model in Excel, something with VOES risk or at risk or something. And we can use this to analyze risk exposure, taxes, sliding scale royalties, various other things as well. So this is where we have to sort of make some choices. Some of the dynamic numerical techniques that are out there, we have binomial trees. That's the upper graphic there, where we start off at a current spot price for a metal, and we allow it to split into two different, as you go forward in time, into 2 different outcomes. Quite often used for option pricing analysis. For the stuff that we do in the mining industry, it's a bit of a limiting approach. We have a limit on the number of price series we can do. We don't get a lot of risk information. We can't deal with path dependence like tax loss carry forwards and things. So binomial trees are a great graphical approach to explaining what you're doing, but in terms of actually running your analysis, not so good. I tend to use simulation use model risk. I find it works very well and very flexible for what I do. The only real restriction here is, it takes a bit of training to get your models right. So, think about dynamic cash flow modeling. The reason why I get excited about it is it helps us reduce the bias in our static cash flow models, and it really expands our ability to talk about risk. And for this, on the static cash flow model side, yeah, we can talk about the benefits of our investment by net present value and various other measures, and we can do exactly the same thing with dynamic cash flow modeling. Unfortunately, for the static cash flow modeling, if we're going to talk about risk exposure, we're really limited to some form of sensitivity analysis, where with the dynamic cash flow modeling, we can still do sensitivity analysis, but we can also start talking about risk exposure in event, around event probabilities, uncertainty measures, loss thresholds, and conditional expectations. And then we also, in terms of communicating our results, have a lot more tools for us. We can talk about confidence boundaries, decision boundaries, all these sorts of things. So with dynamic cash flow modeling, we have a lot more tools to talk about risk and value and the different project characteristics that might influence our decision about whether to go ahead with a mining investment. So just to summarize this, dynamic cash flow modeling has a number of benefits. It does take a lot of, it does take extra effort to do, some training, but it's not, I don't think it's prohibitive. And I really do think that extra effort is really is paid for by the additional benefits that you get from it. The three benefits that I always think about with dynamic cash flow modeling, first is reducing cash flow estimation errors, getting away from that flaw of averages problem. With it, because we are able to include a dimension of risk in our analysis, we have an ability to talk about risk that we wouldn't have with the static cash flow model. And lastly, by doing that extra work, thinking hard about the uncertainty, how we might manage it, how we might finance an uncertain project, it really does help us understand our project better. And all these three things will help improve the quality of the information going into our investment decision. So where I want to go now with this is just talk about a couple of applications here. The first is using IBRM to look at management flexibility. And the idea behind flexibility is if I have an inflexible project, I have to make a decision about whether to invest in it. And that black line there, that sort of stylized histogram there, is showing you, sort of the range of outcomes for that investment. And if things go badly for us, we can expect to lose a lot of money. If things go well, we'll make, we can make quite a bit. But there's a very wide range of possibilities here. And and the thing about flexibility, it allows us to adapt our investment for a future business environment. And so if things are going badly, well, we can take measures to avoid further losses. So we can shut down early, or we can, reduce the capacity in our project. And if things are going better, well, we can expand or we can develop another zone or another area of our projects. And the thing about flexibility is that is going to add some value to our project, and that can impact the way we view our project. Now, to illustrate this, I have a case study. I was using the Skouries project. This is the project in Greece that Eldorado is building, Eldorado Gold. They're going to be building a gold project where they have an open pit. That's the graphic on the lower right-hand side, with an underground section. And so you're going to have an initial open pit, and then an underground first phase, and then you're going to have to make a decision about a second, deeper underground phase where you'd have to invest more money for it. Initial capital development is just under $1 billion. And then further on in year 8, you'll have to make a decision about spending another $440 million, whether to extend the ore body and mine deeper underground. Now, here's what the project looks like. It's a pretty nice project, 2 years to build, 20-year operating life. With both the underground and open pit capital, about 1.4 billion, and your operating margin is 50%, net income margin around 40, and then net margin 31. So that's from a mining perspective, that's a very positive outcome. And the cash flows there, you can see the gray lines on the graphic on the right-hand side there, the cash flow bar graph. The grays are capital investment, and then the light green parts of the bar is the net profit, net income from operations. So the gray bars there are paying for the light green bars. And so what you're seeing is that this is a project that looks, fairly positive. I'm going to add in a couple of areas of uncertainty. I've got gold price uncertainty. I'm using a non-reverting gold price model for the project, and then there's also copper. It's a copper gold project. I think it's about 45% of your revenues are coming from copper, and for that I'll have to use a reverting model to model copper price uncertainty. There's also project flexibility, and what's interesting here is you make your initial decision to develop the project, and you're going to pay just under $1 billion for that. And then you have to make an additional decision in year 8, depending on how the project is going, of whether to invest another $440 million to develop a deeper underground zone. And that's a question. If things are going badly, well, you don't have to invest that next $440 million. You can actually go and develop, and then if things are going well, you can make the decision to invest $440 million and extend the life of the mine to 22 years. So there's that level of flexibility in this project. You can also shut down early as well if things are going poorly. Now, when I ran the analysis, I ran a flexible dynamic program to do this. It's done in Excel. And if I'm looking at your static model versus a dynamic with no flexibility versus a dynamic model where we're picking up flexibility as well, what we find is all our net present values are pretty much the same. Just over $2 billion, total rates of return of 24%, good profitability index. So what you're seeing here is flexibility doesn't, in this case, add much value. The graphic on the bottom there is what I call a policy probability map. The horizontal axis is the project time. The vertical axis is the proportion of scenarios in your simulation that choose a particular policy. And what you find here is at year 8, basically 100% of the time, you're going into phase 2, so you're investing in the next $440 million to go deeper underground, and it's only very late in the project life when you're almost done and the grades are lower, so your unit costs are higher, that you start thinking that you might want to shut down early. So in this case here, there's really not much benefit for looking at flexibility. You can do this analysis on a no flex basis. So, it's great that we're using simulation. We have some indication of cash flow risk here as well, but dealing with flexibility, not all that exciting. So what I did next was I said, well, what happens if we look at the project, that same project setup, but with different levels of operating costs and different percentages of gold revenue in the revenue stream. And the reason why I varied the proportion of gold in the revenue stream is if you look at copper gold projects worldwide, you see a very wide range of mixes of copper and gold. Some have low gold and high copper. Others are completely opposite. You also see that there's a wide range of net income margins as well. So, just because for this particular project flexibility isn't doesn't really impact the value, doesn't mean for other projects that flexibility won't be of interest. And so when I did a flexible analysis across a range of different outcomes, combinations of operating costs, leverage, and the mix of gold, what you find is with the operating policy map for a low margin project and with a lot of gold in it, you can see that there's flexibility is really important. There's a 65% chance, only 65% chance that you'll go underground or go deeper underground, do the phase 2 of the underground, and a 35% chance that you just carry on with your first phase. As you add gold add copper into your revenue stream and improve the margins, that going under that flexibility becomes less important. And then when you have high margins and pure copper play, you tend to always go into the underground. And so in this case here, this lower case here, flexibility is quite a bit less interesting. We can look at this 3D graphic here is showing you how important or how cash flow uncertainty varies in different permutations or combinations. The x-axis here, we're looking at the net income margin from 20 to 40%. On the z-axis, revenue percentage from gold from 0 to 100. And then the vertical axis is the net cash flow uncertainty. And what you're seeing here, what this is showing you is for, a very low net income margin of 20% with a high proportion of gold, your life of mine cash flows are really uncertain, 216%. But as you factor in increasing the amount of copper in your revenue stream and improving the net income margin, you can see your life of mine cash flow uncertainty declines from 200 to 45%. So you can see that there's very wide range of spread of different levels of cash flow uncertainty depending on the project characteristics, your net income margin, and the mix of gold to copper. In terms of value added by flexibility, a low income project with a high level of gold, the value of flexibility is 500 million. But add in copper and improve your net income margin, and the value of flexibility declines to almost zero. So in this case, only $8 million. So you can see, depending on your structure of your project, flexibility may or may not be that important. So it really depends on the project itself. So just to sum up, copper gold projects, because gold is non-reverting and copper has a reverting price behavior, can display a range of value and risk levels that really depend on the project itself. So it's not a case of, well, let's just use 8% or a 5% discount rate. You actually have to get into using a dynamic model to really understand the risk characteristics of your project. Now I'm going to take a look at mining project finance. I think for dynamic cash flow modeling, project finance is a really interesting application and one with a lot of potential. The thing about project finance is when you get into the term sheets for different financing, there's a lot of funny terms that can distribute cash flow in funny ways. And so this can really cause some risk transfers and cash flow risks, cash flow transfers that you wouldn't normally expect. Project finance is really important for the mining industry. I know sometimes when I talk to people, mining engineers, they kind of dismiss the finance industry as, a necessary evil, but really it's understanding finance is important for, advancing your project. On the equity side, issuing equity tends to be really expensive for existing shareholders. So as a mine owner or a shareholder, you're actually interested in project finance because that can improve the returns to your equity investment and also your capital efficiency. On the non-equity side, well, not everyone wants to own a mine, so they don't want to be a shareholder in a mining company, so they'd be looking at different ways of investing. And this project finance allows non-equity investors to tailor their investment to their preferences about how they want to invest in the mining industry. Now, the key thing here is when you're designing a financing package, it's really going to depend on your project characteristics, how profitable it is, the market conditions, and your management preferences about, what sort of structure of financing package should have. I've met some CEOs in the mining industry who swear that alternative finance is not the way to go. Other ones that are quite, open to different ways of financing a project. Different types of ways of financing. You have equity, we have conventional debt, we have resource-based financing where a non-equity investor will put some money up, invest in the project in exchange for receiving some of the future metal output from the particular deposit area. So this is like streaming, net smelter royalties, sliding scale royalties, offtake agreements. These are all resource-based financing. We have derivative financing, where contracts are linked to future contract payments are linked to future market conditions. Things like costless collars and prepaid forward agreements. And then we also have financial support coming through, like loan guarantees and export credits and those sorts of things. So there's a really wide range of financing techniques for mining projects, and they all have an impact on the risk profile of each way of investing in a project. Now, I'm going to look at a couple of examples here very quickly. The first one is the Back River Gold Project. About 3-4 years ago, Sabina Gold was advancing the Back River Gold Project in Nunavut, Canada. And they went to get project financing from Orion Mine Finance, which was a private equity group, and they were going to invest in an offtake, prepay some senior debt, and an equity investment. And then they also went to Wheaton Precious Metals to get a gold stream and an equity investment. And they also did a third party equity raise. And so what's interesting about this is looking at the combination of financing and how the risk was, how risk and uncertainty was and return was shared between all these different investors. The project itself, quite a nice looking project. Profit operating margin 61%, netting over the life of the mine, net income margin 40%, and then net cash flow margin 33%. So nice looking project. I was going to model the uncertainty just using a standard non-reverting gold price model, and with the long-term forecast, initial long-term price forecast of $1,800 an ounce. In terms of financing, Orion, I mentioned before, an offtake, prepay, senior debt, and some equity. Wheaton, that is a streaming agreement and with equity, and then a third-party equity raise that Orion and Wheaton made their financing conditional on Sabina raising some additional equity. Now, what was interesting with this was I initially ran a all equity assessment of the project. What does the project look like if you didn't use project financing? And the graph on the right here, this black line is showing you the chance of early closure due to price declines. And you can see early on for the first few years, very low probability of shutting down early. Then after year 10, you're starting to get into lower grade materials, the chance of shutting down early increases. And then finally, when you get into the very last tail end of the project where your amount of gold is low and your unit costs are high, chance of shutting down early is quite high. When I do financing, if I was to do the financing without the equity raise, so I just take the financing packages without any additional funds from an additional equity raise that provides, a buffer of, cash for, sort of for cash overruns and things, the chance of early closure goes up to around 20% and, increases to about 25 before declining. And so what you're seeing here is with all that financing package, but if you don't raise any additional equity, the chance of early closure jumps up quite significantly. Then if I add in that additional equity raise, where you use that additional equity to provide some excess funds for the project in case things go wrong, what you find then is your chance of early closure actually declines for the project down close to an all equity financing level. So what's interesting here is we can use dynamic cash flow modeling to model, how much additional cash should we have in reserve for a project to avoid getting into trouble. The other thing I did with this example was I looked at the individual cash flow, life of mine cash flow uncertainty for the different participants in the project, the different financiers, versus the internal rate of return on each of the forms of finance. What I found interesting, this big circle here, this is representing the Orion net cash flow uncertainty. It's around 65% here. And they're going to get an internal rate of return of around 18%. And they're investing here $375 million. So the bubble size here represents the amount of capital that Orion invests in the project. The blue dot, the blue circle here represents the risk and return of Wheaton's investment. Their cash flow uncertainty over the life of the project is 115%, and their return is around 7 or 8, and they're investing 145 million. What's interesting about this is what you see is there's kind of a negative relationship between risk and return in this financial structure. And if you study finance, generally people think in terms of greater the risk, the higher the return. And what you're seeing here is that Wheaton is actually over-investing up front in providing too much capital in the project and ending up with a much riskier cash flow over their life of mine. So what you're seeing here is that the risk and return structure of this is not very favorable to Wheaton. Now, I did another case study around the TZ Gold project in Brazil. This is being developed and put in production by G Mining Ventures. They went to Franco, Nevada, to get financing. And just to quickly jump ahead, once again, a very nice little project. I was using a non-reverting price model here for gold. And what I did was a bit different here. Was I looked at the financing structure and I said, well, what happens if we vary the amount of stream and debt in our financing structure? And so, in terms of overall financing, G Mining Venture they raised about 370 million in non-equity financing. And the question for me was, what happens if you mix up the stream and the debt in your financing structure? And here's what that looks like. If you were just to finance with all equity, your expected return on the equity IRR is around 25%, and life of mine cash flow uncertainty for equity is around 78%. But up here, this is what happens when you introduce non-equity financing and you're playing off the streaming and you're mixing the proportion of stream and debt. If you just go with all debt, your equity IRR with all debt is just under 40%, so 38%. But your equity cash flow risk is pretty high. It's around 87%. And as you mix in streaming, where Franco-Nevada invests some capital in exchange for actually receiving future metal production, what you find here is your equity cash flow uncertainty declines and the equity IRR goes up. And the reason why this is happening is because the streaming cash flows are tied to metal price, whereas debt, its cash flows are contractually fixed. And so with fixed cash flows in your financing structure, that increases the risk for your project or for your equity cash flow stream. Now, I'm just going to step on to the last case study here, where I'm dealing with a corporate portfolio exposed to market and technical and execution risk. Country risk is very important in the mining industry. Mining companies invest all over the world. The problem for mining companies is they can be exposed to a great deal of country risk depending on where they're investing. And the problem for a mining project tends to be, your mining projects are immovable and they require a lot of capital up front, and they become targets for host countries for changing taxation structures and things, because these projects, if metal prices are high, can produce a lot of excess profits. And so governments, if they're facing revenue shortfalls, tend to look to mining projects to potentially change taxation structures and things. And then you can also deal with potential bias as well. And so these end up producing a lot of country risk exposure for mining companies. We tend to recognize country risk in our cash flow modeling through discount rates. So generally, hey, a company will look at a copper project and say, let's use a baseline 8% discount rate. We're in this part of the world, so let's increase that discount rate by another 5% to 13%. And that increase in discount rate represents a risk premium for country risk. What I'm going to talk about here is what happens if you change that into a cash flow effect where we have a country risk loss model, and how that changes the way we might look at our project. Now, the example I'm going to use here is B2Gold. 2 years ago, they acquired Sabina and the Back River project in an acquisition. And prior to this acquisition, B2Gold, their flagship operation was in Mali, the Fekola mine, and they had other operations and other exploration projects going on in other parts of the world too, in sort of mid-risk countries like Colombia, the Philippines, and Namibia. And so the question would be is, well, if they acquired the Back River project, how does that change their corporate risk profile? Standard analysis with a static model would show you how your gold production changes before the Sabina acquisition. You'd see forecast gold production, at 800,000 ounces to 1 million before falling off. They would have to find additional sources of production to fill this in later on. Add in Sabina, and you start to push up your gold production profile up to 1 million ounces, 1.2, 1.4. And so part of the reason the acquisition is interesting is it improves their gold production profile, but it also does something where it changes the exposure to country risk. Prior to the acquisition, almost 60% of their production is coming from Mali, which is a fairly risky environment to be working in. Whereas after the Sabina acquisition, their exposure to Mali, as compared to their total production profile, falls to 36%. So by introducing Sabina and the Back River project, they've now increased their portion of production coming from a more stable environment to 36%. I'm going to use a gold price model where a non-reverting gold price model. I'm also modeling in this example here energy price risk with WTI oil price, a non-reverting, or sorry, a reverting model for that. I'm also going to model technical risk exposure where we have exploration and grade uncertainty. I just use a very simple discrete technical risk or exploration risk model for this. You can get into more complex structures if you wish, but the idea is that, for exploration projects, you run an exploration program, you get some information, depending on the results, you may stop, or you may carry on with building the project and then potentially ending up with an operating project. And then I built a country risk model where each year you're testing for closure, depending on, and this is tied into your country risk premium. Now, you can get into much more complex models of country risk, but I'm just doing something simple here in order to see, if I model country risk as a cash flow effect, how does that change my analysis? First off, when you run your analysis, now you have a possibility of losing your future production. These gray bars are production, light gray is from country risk, dark gray is production losses due to technical risk. Key thing here is gold production from your before the Sabina acquisition. The combined potential losses from negative outcomes in your simulation from country risk and geological risk is about 45%. But add in Sabina, and your losses from country risk and geological risk drops to 40% of your life of mine production. So what we're seeing here is that your expected losses from your production decline by acquiring a project in a more stable jurisdiction. We can also look at individual risk levels of the projects, market risk on the x-axis, technical risk on the z-axis, and then execution risk on the vertical axis. These ones are exploration, the Anaconda project, which is an exploration project in Mali, very high execution risk and fairly high technical risk. Market risk, you can see the different projects here. What this graphic does is it allows you to understand or get a feeling for how the individual projects in your corporate portfolio change, or the relative risk components in each project. I can also look at this on a portfolio basis. This is your risk profile for the corporate portfolio without Sabina. You have high levels of execution risk, fair amount of market risk, and when you add in Sabina, you see there's a big reduction in your execution risk profile. So with simulation, you can start looking at these sort of things about, hey, I have a portfolio, where do I want to go with it? If I invest in an unstable jurisdiction, how does that change my risk profile versus a more stable jurisdiction? So just to wrap up now, key thing here, uncertainty really complicates investment decision making, and it makes it really difficult for us to understand the project when we're exposed to uncertainty. Static cash flow models, difficult to really think about risk beyond spider plots, which aren't very effective. Using dynamic cash flow modeling really helps us expand the description of our project to include very explicit descriptions of market risk exposure, technical and execution risk. We've gone through a series of case studies looking at flexibility, financing, and portfolios. Really, these case studies are helping us understand, what are the benefits of using dynamic cash flow modeling? Is this helpful for us to better understand our project and the risk exposures that we're exposed to, and also in comparison to other choices we might have for investing capital and some of our preferences there. All right, so that's my presentation. Jameson, I'll turn it over to you. So